The Cumulative Volume Index, or CVI, is a technical analysis indicator that tracks the cumulative flow of money into and out of a security. Unlike regular volume indicators, CVI provides a running total of volume that's adjusted for price direction. Standard volume simply measures the trading activity at a specific point in time, without accounting for market direction. CVI, however, accumulates volume over time and factors in whether the price is moving up or down. Let's visualize how CVI accumulates volume data over time to create a clearer picture of buying and selling pressure. Here we have a price chart over time. First, we'll add the trading volume for each period. Notice that green bars represent volume on up days, while red bars show volume on down days. CVI accumulates this volume data into a running total, adding volume on up days and subtracting volume on down days. Now let's look at why traders use CVI as part of their technical analysis toolkit. CVI helps identify underlying buying and selling pressure that might not be immediately apparent in the price action. It can show trend strength and potential market reversals by tracking the accumulation of volume over time. Traders look for divergences between CVI and price, which often signal important market turning points. Finally, CVI helps filter out daily volume noise by focusing on the bigger picture of volume flow. In summary, the Cumulative Volume Index provides valuable insights by tracking the cumulative flow of volume adjusted for price direction, helping traders identify potential market trends and reversals. The Cumulative Volume Index is calculated using a straightforward formula that tracks volume changes in relation to price direction. Price direction is a crucial component that determines whether we add, subtract, or ignore the volume for a given period. Let's walk through a practical example to see how the CVI is calculated over several trading days. Here's a 5-day example showing how CVI values accumulate over time. On day 1, with a closing price of $50, the volume is 1,000 shares, and the price direction is positive. Since there's no previous CVI, we start with 0 and add the product of volume and direction. On day 2, the price increases to $50.50, so the direction remains positive. We add the volume of 1,200 to our existing CVI, bringing it to 2,200. On day 3, the price drops to $50.25, giving us a negative direction. We subtract the volume of 800 from our CVI, resulting in 1,400. Day 4 shows no price change, so the direction is 0. This means we neither add nor subtract volume, keeping the CVI unchanged at 1,400. Finally, on day 5, the price increases to $51, returning to a positive direction. Adding the volume of 1,500 brings our final CVI to 2,900. Let's now visualize how the CVI changes over these 5 days in relation to price movement. This chart shows how the CVI in gold changes in relation to price movement in blue. Watch how the CVI line develops over the 5 days. Notice how it rises when prices go up and falls when prices go down. Let's summarize what we've learned about calculating the Cumulative Volume Index. The Cumulative Volume Index starts at 0 and builds over time. It adds volume on up days, subtracts volume on down days, and remains unchanged when prices don't move. This creates a running total that reflects the balance between buying and selling pressure in the market. Let's examine how the Cumulative Volume Index compares with other popular volume indicators. The Cumulative Volume Index tracks volume changes based on price movement. It accumulates volume on up days and subtracts it on down days, providing a running total of volume flow. On-balance volume, or OBV, adds all volume on up days and subtracts it on down days. It uses a simpler calculation than CVI and only looks at daily closing prices. The volume flow indicator measures volume and price changes over a specific period. It applies additional filtering and smoothing using a more complex formula with multiple variables. Let's visualize how these indicators respond to the same price action. The Cumulative Volume Index responds smoothly to price changes, accurately reflecting the volume flow during the trend. In comparison, on-balance volume shows a similar pattern but with less sensitivity to smaller price movements. The volume flow indicator applies more smoothing, resulting in a less reactive but potentially more stable signal. Let's compare these indicators across several key features. In terms of calculation complexity, CVI is moderately complex, OBV is the simplest, and VFI is the most complex. CVI offers high price sensitivity, OBV provides medium sensitivity, while VFI typically shows lower sensitivity due to its smoothing. CVI generally provides clearer signals, OBV can be somewhat noisy, and VFI offers more smoothed signals. Let's discuss when traders might prefer to use CVI over other volume indicators. CVI works particularly well during trending markets with consistent volume. It's excellent when looking for volume confirmation of price breakouts. CVI excels at detecting early divergences in trend strength, often before they become visible in other indicators. It's particularly useful when analyzing markets with high volatility, where other indicators might give false signals. CVI performs differently across various market conditions when compared to other indicators. During strong trend periods, CVI excels, while OBV and VFI perform well but with less sensitivity. In ranging markets, CVI maintains good performance, while traditional indicators often give mixed results. During breakouts, CVI provides early confirmation, while OBV and VFI often show delayed responses. In highly volatile conditions, CVI maintains stable signals, while other indicators often become noisy and less reliable. Let's summarize the key differences between CVI and traditional volume indicators. CVI provides clearer signals during trending markets than OBV or VFI. Traditional indicators often lag behind CVI in detecting breakouts. CVI maintains reliability in volatile markets where others become noisy. For divergence analysis, CVI often provides earlier warning signals than other volume-based indicators. With these comparisons in mind, let's look at how to identify trend strength using CVI in the next section. In this section, we'll explore how to identify trend strength using the Cumulative Volume Index. One of CVI's primary uses is confirming price trends. When CVI moves in the same direction as price, it suggests the trend has strong volume support. Let's look at an example of a strong uptrend, where both price and CVI are rising. In a strong uptrend, we see price steadily climbing over time. The Cumulative Volume Index also rises, confirming this bullish trend. When both price and CVI rise together, it indicates strong volume support for the uptrend. This parallel movement confirms the trend's strength and suggests it's likely to continue. For traders, this confirmation supports a bullish bias. It's an opportunity to consider long positions, potentially using pullbacks as entry points. Now, let's examine a strong downtrend where both price and CVI are falling. In a strong downtrend, we see price consistently declining. The Cumulative Volume Index also falls, confirming this bearish trend. When price and CVI fall in tandem, it signals strong selling pressure. This synchronized decline confirms the downtrend's strength and suggests further price deterioration is likely. For traders, this confirmation supports a bearish outlook. It presents opportunities for short positions, potentially using price bounces as entry points. To summarize, CVI is a powerful tool for confirming trend strength. When CVI moves in the same direction as price, it suggests the trend has strong volume support and is likely to continue. This confirmation increases your confidence in trade decisions, whether entering long positions in uptrends or short positions in downtrends. In the next section, we'll explore how to identify divergences between price and CVI, which can signal potential trend reversals. Divergences between price and the Cumulative Volume Index can signal potential trend reversals. A bearish divergence occurs when price makes a new high, but the CVI fails to confirm with its own new high. Notice how the price shows a higher high, while the CVI shows a lower high. This divergence suggests weakening buying pressure despite rising prices. This bearish divergence indicates that despite the price reaching a higher peak, there's less volume supporting the move, suggesting the uptrend may be weakening. Conversely, a bullish divergence forms when price makes a new low, but the CVI doesn't confirm with a corresponding low of its own. Here, the price shows a lower low, but the CVI shows a higher low. This suggests increasing buying interest despite falling prices. This bullish divergence indicates that despite lower prices, there's increasing volume support, suggesting the downtrend may be losing momentum. Let's explore how traders use CVI divergences in their trading decisions. Divergences provide early warning signals, but aren't exact timing tools. Smart traders wait for price confirmation before taking action. The strength of the divergence often correlates with the strength of the reversal. Wider gaps between price and CVI behavior typically produce more significant moves. Multiple divergences on the same chart increase the reliability of the signal. Finally, consider the timeframe context. Divergences on higher timeframes, like daily or weekly charts, tend to be more significant than those on shorter timeframes. Remember these key takeaways. Bearish divergences provide early selling signals, while bullish divergences offer early buying opportunities. CVI behavior changes significantly across different market conditions. We distinguish between trending markets, where CVI shows a clear directional bias, and ranging markets, where CVI tends to oscillate without clear direction. In a bull market, CVI typically shows a strong upward trend. As prices increase, CVI grows steadily. Notice how CVI maintains its upward bias even during minor price pullbacks. Temporary flattening in CVI often indicates brief consolidations before the trend resumes. The optimal trading strategy in bull markets is to buy dips when the overall CVI trend remains upward. In a bear market, CVI demonstrates a strong downward trend. As prices decline, CVI continues to decrease. Even during temporary price rallies, the overall downward CVI bias remains intact. Brief flattening periods typically indicate consolidation before the bearish trend continues. In bear markets, the optimal trading strategy is to sell rallies when the overall CVI trend remains downward. In sideways or ranging markets, CVI typically oscillates around the zero line without a clear directional bias. Note how CVI tends to move in a more confined range with lower amplitude. This reflects the lack of strong buying or selling pressure in the market. The appropriate strategy in sideways markets is either range-bound trading, buying at support and selling at resistance, or reducing position size due to the lack of strong trend. To summarize, identify the market condition first, then apply the appropriate CVI strategy. In bull markets with upward CVI bias, buy dips. In bear markets with downward CVI bias, sell rallies. In sideways markets with oscillating CVI, employ range trading strategies or reduce position sizes. Combining the Cumulative Volume Index with price patterns significantly improves trading decisions. Using CVI with price patterns offers three major benefits. It confirms genuine breakouts, reduces false signals, and helps time entries and exits more precisely. Triangle patterns are common consolidation formations. When combined with CVI analysis, we can better predict which breakouts will succeed. Here's a typical triangle pattern formation. As price consolidates, CVI often shows decreasing volume until the breakout. The breakout occurs when price moves decisively above the upper trend line. The critical element is that CVI rises significantly at the same time, confirming the breakout. When price and CVI trend in the same direction during a breakout, the probability of a successful continuation is much higher. The head and shoulders pattern often signals a reversal. CVI helps confirm if the neckline break will lead to a true reversal. A key aspect of head and shoulders patterns is the volume profile. Typically, volume decreases from the left shoulder to the head and again from the head to the right shoulder. The pattern consists of a left shoulder, head, and right shoulder with a neckline connecting the troughs. The crucial breakout occurs when price breaks below the neckline. CVI should show a decrease during this breakdown, confirming the bearish reversal. Not all price breakouts succeed. Let's examine a rectangle pattern where price breaks out but CVI doesn't confirm, leading to a failed move. In a rectangle pattern, price oscillates between support and resistance levels. A breakout should ideally be accompanied by increasing volume. Notice how price breaks above the upper bound, signaling a potential bullish breakout. However, CVI fails to increase with the breakout, a warning sign. Without CVI confirmation, the breakout fails. Price eventually reverses and falls back into and then through the rectangle pattern. Let's review some best practices for combining CVI with chart patterns. By combining CVI analysis with traditional price patterns, you significantly increase your probability of successful trades and reduce false signals. Let's explore how to set up the Cumulative Volume Index indicator across popular trading platforms. On TradingView, start by clicking the Indicators button in the top toolbar. Search for Cumulative Volume Index or CVI in the search bar. If you can't find it in the built-in indicators, check the Pine Script section or Community Scripts. To customize the indicator, right-click on it and select Settings. From there, you can adjust the period, colors, and thickness. In MetaTrader, start by opening the Navigator window by pressing Ctrl+N. Expand the Indicators list and look under the Volumes category. MetaTrader doesn't include CVI by default, so you'll need to use alternatives like On-Balance Volume or Money Flow Index. To add the indicator, simply double-click it or drag it onto your chart. You can adjust the period and other settings in the Indicator Properties dialog. In Thinkorswim, click on the Studies menu and select Edit Studies. Search for Cumulative Volume Index in the search bar. If the indicator isn't available, you can create a custom study using ThinkScript. Once added, you can configure settings like style, colors, and period length to match your trading preferences. If your trading platform doesn't support CVI, here are some alternatives you can use. On-Balance Volume, or OBV, is available on most platforms and offers similar insights to CVI. Money Flow Index combines price and volume data to show buying and selling pressure. For advanced users, creating a custom script is the best way to implement the exact CVI formula. Regardless of which platform you use, here are some important tips for setting up the Cumulative Volume Index. Section 9. Common mistakes when using the Cumulative Volume Index. Even experienced traders can fall into these 3 critical traps when working with CVI. The first major mistake is over-reliance on CVI without considering other factors. Many traders make buying decisions based solely on rising CVI, even when price action clearly contradicts this signal. A better approach is to always confirm CVI signals with price action and other technical indicators before making trading decisions. The second common mistake is misinterpreting minor divergences as significant trading signals. Many traders overreact to small, insignificant divergences like this one, which are often just market noise. A truly significant divergence like this one is more pronounced, lasts longer, and occurs at key price levels. To avoid this mistake, focus on divergences that extend over multiple periods, show a substantial difference in direction, and occur at key support or resistance levels. The third critical mistake is using inappropriate timeframes for your trading strategy. On a daily timeframe, CVI may show a clear uptrend, suggesting bullish momentum. Yet on an hourly timeframe for the same period, CVI might fluctuate significantly, giving contradictory signals. To avoid this mistake, follow these timeframe selection guidelines that match your trading strategy. To use CVI effectively, develop a balanced approach that avoids these common pitfalls. Remember that CVI is just one tool in your trading arsenal. It works best when combined with other indicators and proper market analysis. This comprehensive CVI trading strategy incorporates all the key concepts we've covered in previous sections. It gives you a complete framework for making decisions in the market. When looking to enter a trade based on CVI, we need several conditions to align. First, look for price breaking a key level. Next, ensure the CVI confirms by increasing in the direction of the breakout. The slope of the CVI should also be steepening, indicating growing momentum. In a bullish scenario, we enter when price breaks resistance with CVI trending upward. For bearish trades, we look for price breaking below support with CVI trending downward. Knowing when to exit is crucial for profitability. The most reliable exit signal is a divergence between price and CVI. This happens when price continues in one direction, but CVI starts moving in the opposite direction. In this example, we see price continuing upward, while CVI begins to decline, creating a bearish divergence. This signals decreasing buying pressure despite higher prices, often preceding a reversal. Proper risk management is essential for long-term success with any trading strategy, including CVI-based approaches. Start by risking only 1 to 2% of your trading capital on any single position. Here's a practical example of position sizing. If you have a $100,000 account and risk 1%, that's $1,000 per trade. With an entry at $50 and stop loss at 48.50 cents, your risk is $1.50 per share. Dividing your $1,000 risk by 1 or 50s gives you a position size of 666 shares. Now let's walk through a complete trading example using our CVI strategy. We begin by identifying a potential support level where price has stabilized and CVI is showing signs of bottoming. We enter the trade when price breaks above the consolidation with increasing CVI, confirming the momentum. Our stop loss is placed below the support level with a price target that gives us a risk-to-reward ratio of 1:3. As the trade progresses, we monitor the relationship between price and CVI. When we see a bearish divergence forming, with price making new highs while CVI begins to decline, we prepare to exit the position near our target price. To summarize our CVI trading strategy, we enter trades on price breakouts that are confirmed by CVI movement. We exit based on CVI divergences or predetermined profit targets. Proper risk management through position sizing is essential, as is monitoring the CVI's slope and direction for ongoing trade management. Before implementing this strategy with real capital, it's highly recommended to practice in a demo account to gain familiarity with CVI signals and refine your execution.